something before I make sure my clips were separated. They are, so we're good, good, good. All right. So hopefully my mic will stay on now. I got a nice T-shirt on as opposed to a collared shirt, so I apologize for the how casual I look. But hopefully you'll understand. This mic, like I said, the bar goes up, it cuts the mic off. Pull it down to turn it on. And I think my collar was making the bar go up just a little bit, enough to cut the mic out. So hopefully now we won't have any more mic issues. We may, and we'll adjust. I've got another mic I can use if I got to, and we'll see what happens. Um, so we're down to, this is the second segment of accounting 4340, chapter 6. We're going to do 4, 5, and 6, and then we're going to pause again for another clip, and we'll be back to do 2 and 3, which are much shorter, okay, which is the next two questions. This is still question 1. It's a very lengthy question, okay? So number 4 here is essentially we're reclassifying, okay? So it says here, tax reported serial bonds with a $3.5 million par value are issued to refund some term bonds. Now, term bonds, if I'm thinking correctly, term bonds are kind of like, they're like a lump sum. So it's almost like a CD. So if they were to say, okay, we're going to sell you this bond, it's $1 million, 6%. We'll pay you back in 10 years. So you get no streams of anything coming in. At the end, you'll get a lump sum payment, which will be the principal plus the interest when that bond comes to term or matures. Okay. And then the serial bond is your more traditional, like, twice a year payments of interest and principal to kind of pay it down as you go, which is a lot more typical. People, they want to see that cash flow and, that stream of cash payments coming in. And so it may be a little bit more marketable, a little bit more easier to sell as serial as opposed to term. And so we're going to refund it here, okay? So we're going to essentially reclassify, but it's a little bit of a process. Okay, so the first thing we're going to do is we're going to record the issue of the serial bonds. So this is the debt service fund. We're going to have the cash coming in, and that cash amount will be the $3.5 million. And this is going to be the proceeds from those refunding bonds, okay? So really it's serial bonds, but because we're going to use it to refund another bond, we're going to give it that classification here. So it's an other financing source, okay? And there is no other real use. This one would be kind of, well, not really close, but it's proceeds of a bond at least. So we're going to do proceeds of refunding bonds. Now I would see just, bond proceeds kind of works there too. But the refunding gives a little more information, obviously, okay? And now we're going to record the refund. Okay, so this is going to look strange too. Let me double check it before I... yeah. Okay, so we're going to pay the old bonds off, which is going to be a cash payment of the $3.5 million. This is going to replace or get rid of the term bonds that are now going to be serial bonds. And this is going to be an other financing use. And it looks really strange, right? So payment to refunded bond escrow agent. Now, see, how would you gonna know that, right? So if you do look in the chapter 6, I believe, let me double check while I'm here real quick. This does show up in one of the illustrative journal entries here, so you can find something similar in the book, but because I kind of glossed over that, I can get you a page later if you need it, but it should be in the chapter. But we just didn't really cover it. I didn't really lecture. I just told you about those 3 important terms. You can go to the text to see those journal entries, which most of them we're covering now anyway. Okay, so that's going to be the debt service entries. Oh, let me put the money in here. I got some unbalanced entries. Okay, now we're better. Okay, that looks better. Okay, governmental activities, record the issue of the tax supported serial bonds. So this is going to be cash again, and probably going to be serial bonds payable. Okay. One more. There we go. And then we're going to record the refund of the par value bonds. So this is the term bonds, right? So term bonds payable. Oh, that's not it. Let me try it again. Term bonds payable. Okay. We're going to debit those to get rid of them because they've been replaced with the 4C, which is the serial bonds payable. This is where our cash goes to that escrow agent. Okay. Okay, so that should take care of that one. Okay, now we're going to go on to number 5. 5A. Debt service fund. 4 months prior to year end is 6% special assessment, totaling, oh, this is a tough one, totaling $500,000 were issued to fund a street light improvement project for a local subdivision. The bonds are secondarily backed by the village, kind of like a cosigner. The $25,000 installment will be due from property owners 6 months after the initial bond issuance. No debt payments are due in the first year. Okay. So the debt service fund, we're going to record the issuance of this special assessment. So this is we're going to have some cash coming in, right? That $500,000 worth of cash. We just got to figure out where to put it. So the $500,000 cash should be an easy line to put in the entry. Now the second part is not so easy, but it is going to be proceeds from a bond. So proceeds, this could be other financing source. So let's see what we got. And this one here, okay, we do have, this is a special assessment as it says in the problem, so that's going to be our correct choice there. Financing source, proceeds from special assessment bonds, okay? So there's that. All right. Now it says to record the current and deferred installment receivables from the local subdivision. So this is going to be a special assessment, so the people that live in this neighborhood are essentially paying for this bond over time, or paying this debt over time. So it's going to be like receivables, right? So they're like deferred receivables. So, or part of it is current. This is the first installment is due 6 months. That's current, right? Less than a year. So that's going to be current, where the other 475 will be more of a deferred or a future receivable, if you will. Let's see what we got. So we got to record some receivables. So we're going to have a accounts receivable. Wait a minute. Not a, is it accounts receivable? Where am I at? Oh, there we go. Assessments receivable, right? So we're talking about, it is a receivable, but not accounts receivable. So we got a current receivable for our assessment, and then we got a unavailable portion as well. Okay, so of course the current part is the $25,000. The unavailable part will be the 475, which is the, you know, well past a year. It says, you know, a year later. It says no debt payments are due in the first year. The first payment will be in 6 months, though. We will receive the first part of it in 6 months. That's the receivable. Okay. Okay. So that's $25,000. It's going to be tax revenue. Because now we are in the debt service fund, so we don't have any sort of special name for it other than just revenues. And then we will, in the subsidiary ledger, we'll All right, I'm gonna have to change mics here. This is not good. Not good. Let me just have a moment to decompress here and call, what did he say in that for love of the game? Clear the mechanism. All right. Uh, Not sure what I cut out there. So nobody's watching. Ooh. Okay. Let me continue. Okay, and might just let it ride. So I'll just say, hey, part of it cut out. Follow along. I don't know. We'll see. Okay, let's continue here. I'm just gonna have to monitor that microphone closely, I guess. All right. Um, hmm. Let's look at this again. Let me come back up here. You can always fast forward to the VOD. All right. So cash, $500,000. Okay. Other financing source. This is going to be to record the receipt or the cash receipt from those bonds. Okay. So you can see here that special assessment bonds. That one's not bad. But then down here, okay, we're going to record these assessments receivable. So only $25,000 is receivable currently because it says 6 months and nothing else for a year. So the rest is unavailable. And you split it up down here. We actually come back to this deferred revenues thing down here. Or sorry, deferred inflows. All right, so that's a little tricky one. Hopefully I don't know what I cut out, so hopefully I didn't miss anything from 4. I can double check before I upload. Let's keep going on down here to number 5. In the governmental activities, we're going to record the issuance of the special assessment bonds. We got the cash coming in. Okay, now this is going to be a liability, right? Because we may have to pay this back. So it's going to be kind of a liability. So it is a debt. So it's some sort of a special assessment debt. Let's start to see what comes up here. Special. Okay. Now, I would like it to be called Special Assessment Bonds Payable or Special Assessment Bonds in there to get that word bonds in there, but this is not what it wants. In Connect here, we want to put Special Assessment Debt with Government Commitment. Now, really, it may not even be a true debt because it's ultimately we should not have to pay it back so they were a cosigner, and hopefully that person you cosign for is going to pay it off. By the way, never cosign for anybody. Doesn't matter how good their friend you are, don't cosign. Unless it's your child and you're okay with eventually paying that thing off, don't cosign. That's my advice to you, okay? Um, Special assessment debt here with government commitment, $500,000. Now, ultimately, that might be considered I might look into that. It might be a deferred outflow because it may never be our debt because it really should be covered by the special assessment, okay? 5D, record the deferred installment receivable from the local subdivision. Okay, so this is going to be that receivables again. Yeah, it's very similar actually to this one, except for the revenues. So we're going to have assessment receivable, current and available, and unavailable, I'm sorry. Okay, the 25, the 475. And as opposed to be just revenues, now we can call it like program revenues, right? So we can do program revenues. Okay, is that what we want to use? Let me double check that one. Yeah, so it's just general government. And that's going to be the 25,000. And then the deferred inflows again. Okay. This says record the interest payable on the special assessment debt. Now, we're going to figure this out. Okay, so we got $500,000 6%. I think I got this written down somewhere. Look at me. Okay, so 6%, $500,000 is $30,000. And this is 4 months prior to year end. So we got to do a third of that $30,000. So it's $10,000 in accrued interest. Or accrued interest? Or that, wait a minute, I'm looking at. Yeah, accrued interest. So we want to record the expense and a matching payable. So we're going to do interest expense. So let's put interest expense. Okay, so they've got it spelled out here. Interest on special assessment debt, 10 grand. Remember, that's the third of the $30,000 because it's 4 of 12 months. And this is going to be a interest payable, right? Yeah, interest payable. Matching payable. Good. Now let's get this last one done so we can go on to 2 and 3 and be done with this for now and see how we will assess at the end of the week whether I need to do something different. If we want to do, something a little more structured, we can. We'll figure it out, right? If we need to do a Zoom, they're probably overwhelmed, but like a Zoom or something like that, we can do that too. Capital projects fund. All right, what we got here? Construction bond, sold at par. Debt. Okay, we got some. So this is a little bit new here. We got some administrative fees. Okay, so we're gonna pay some fees. Let's look at what we got here. So the first thing is to record the proceeds. This is gonna be cash, and then proceeds and bonds. So that one's easy. Starts off easy at least, right? Other financing source, bond proceeds. Proceeds from bonds. Let's try that. Okay, there's that one. Now, okay, so within the capital projects fund, we're just going to call it just expenditures, right? Just expenditures, nice and easy. So we're going to have expenditures. Here we go. Debt issuance cost. That's going to be both of these things together. Okay, we're not going to have any sort of a prepaid asset here, even though it's prepaid insurance. We're just going to have $50,000 within that subsidiary ledger. We'll have it broken out as administrative fees and then insurance. Okay. And then the other side of that is going to be what, cash, right? We get paid with cash. Is that right? Sure. $50,000. Okay. Number 6 here. Who's number 6? All right. Make sure my mic. I gotta keep checking. Like mic on. Is the mic on? Is the mic on? Anyway, what's going on down here? All right. Okay, so now we're in the governmental funds. Okay, so we got the cash coming in, $5 million. Oop, that's a zero out. And then we got, what's this other one? Bonds payable, right? Bonds payable? Yeah. Sure it is. And then record the debt cost. All right, so obviously the bottom line here is going to be a credit to cash for $50,000. Okay, we got our debt issuance cost. Okay, some sort of expense, obviously. Might take you a while to find this on the list. So it says bond issuance expenses is the name of that account. So we got bond issuance expenses. I guess if you put in expense and kind of look through that list, you probably would see it and say, yeah, that's probably it, right? So bond issuance expense, and then the prepaid insurance here for the $5,000. And they got the word costs in there. I don't like that, but it's okay. Prepaid insurance. Okay, so let's check our work. Okay, I got an error there. Let's check, see what's going on there. It's in the wrong column, right? We'll fix that one. So it's 5D.